will be inviting our next speaker, Saqib Chaudhary. Saqib Chaudhary has been, he's local to a lot of the people, and he's an accountant definitely, but his topic is about tax, and he is a tax expert. I will not take much time and ask him to come up and start his presentation.
My name is Saqib, and my topic is taxation, and my target is to put at least, not put, but rather show you how you can have at least $10,000 plus in your pocket or in your bank account coming in next financial year. So that is my target. You may have a different target today to come here. Look, Pakistan is playing against India today, a champion trophy match after roughly 4 hours, 25 minutes. It's gonna start. But you are here. You are spending almost 3 hours of your time today. And what should be the return of this 3 hours time? What should be the return? On an average, an IT guy is making about $1,000 per day. On that basis, for 3 hours, you should make at least, yeah. So that is not enough. If we multiply this number by 20, so that is roughly 8 grand. So my target is to show you how you can have more than $10,000 coming into your account next financial year. So that is my target. Okay, disclaimer, this is just a generic information. Whatever is being presented here is just for the education purposes only. And you need to discuss with your advisor if there is some specific scenario. This is my profile. You can just scan this QR code and you can reach me. Okay, next. Okay, financial independence is the objective of a lot of people. And we were just hearing that we should plan our retirement. Everything is going towards our retirement. And we should plan it in such a way that we are very comfortable and we can make our life more comfortable. Okay, I will show you the opportunities available for you. What you can do, what actions you can take that can help you to achieve your objectives. Okay, next slide, please. Look, I put the whole presentation in a way that it can connect with you. Can you raise your hand if you are doing a job, you don't own a house or an investment property? Just raise your hand. So roughly 20 or 30% people. So these people are actually the people who are just doing a full-time job. They don't own a house or an investment property. We call them ATO's darling. Because these are the people who are just working roughly 2 days in a week just to pay ATO. Okay, so this is ATO darling. And for ATO darling, there should be a lot of strategies. But the darling, he or she actually knows from the experience that there are very limited opportunities available for them. And my objective is to bring them out of this cycle and show them the ways that there are a lot of opportunities available for you. I will explain them today. For ATO darling, there are 3 key strategies which they can do alongside a lot of other opportunities available with them. Number 1 is make your concessional contribution in your super, which is ultimately lead towards your retirement savings. So that is the one thing. Second thing is do salary sacrificing. Pay all those expenses which your employer allow to pay them from pre-tax wages. And finally, if you don't have a house and want to buy one, use this third strategy, which is the first home saver scheme. You can put some money into your super, which you can withdraw when you want to buy a first home. So these are the three strategies for ATO darling. Okay, next. Second category is also a darling, but they own a house. They have their own house. For them, their next step should be to buy an investment property. Because buying an investment property saves you a lot of tax. I will show you today how it can work. So salary packaging and the negative gearing are the strategies where they can focus. And is there anyone in the room who is working for a non-profit organization? Like unis, hospitals, or any other non-profit organization. For you people, there is a golden tip for you. Talk to your employer and pay your house rent or mortgage from your pre-tax wages. You can do that. Because for the companies, private companies, employer have to pay tax on these benefits if they are allowing you. But the not-for-profit organization, they are exempt from this. That's why you can easily avail this opportunity. So this is a golden opportunity for all those workers who are working in a non-profit organization to pay their rent. Rent is a big cost these days, or a mortgage, or any other expenses from your pre-tax wages. And there is a limit, about $16,000 you can pay from your pre-tax wages. So $16,000 means at your tax rate, roughly 4 or 5 grand you will save easily. So 5 is coming in your pocket. Next category is the business owners. Any business owner in the room? Startups and other business owners. And the business owners with a house or without a house. If you're a business owner like a startup and you don't have your first home or an investment property, so you fall in this third category. For you, you need to protect your asset because you guys are operating in a risky environment. As compared to the full-time job or workers, you are in a risky environment where you can be sued by your customers or community members or someone else. So you need to protect your assets. Okay, for protection, generally a trust structure is used to protect your asset. But a lot of people, they are buying their first home under their personal name. So what if I would suggest you set up a family trust, work under the family trust, and then buy a property, your first home, under the trust. And in that way, your mortgage would also be tax deductible, which is generally not. If you are buying your first home and paying any interest, that is not tax deductible. But if you are buying your first family home under the trust, then you can have a negative gearing benefit as well. That is a unique strategy, and I think you have a handout in your hands. So that will explain how it's going to work. So that strategy is very useful, and it will save you a significant amount of taxation. Last one, a small business owner have a first house and they don't have an investment property. So for you, you're almost approaching your retirement, or you should plan your retirement as soon as possible. For you guys, first of all, you need to explore all those opportunities to get the government grants. For businesses, there are a lot of grants available, like grant means support from government. So you need to focus on that. get the free money to expand your business, improve your business profitability. There are three grants which is very common. Number one is R&D. If you are in a IT space, then R&D, you should go for R&D grant. If you are a person who is exporting goods or services from Australia, then go for EMDG grant, Export Market Development Grant, where you can get money to take your business into international market. So go for that. And then if you are again in an IT space and you are developing some new products, go for MVP grant, Minimum Viable Product Grant. You need to explore, being a business owner, you need to explore those areas. And then if your business is almost approaching their 10 years and 10th anniversary or 15th anniversary, just focus on 15-year mark. After 15 years of establishment of your business, if you are selling your business, any capital gain from the sale of business would be tax-free. So if you don't know and you're selling your business after 14 years of establishment, you have to pay capital gain tax. So wait another 1 year and get that money tax-free, and that will boost your retirement savings. Again, for these category 4 people, try to have a negatively geared property. That will boost your overall savings. And self-managed super fund, that is a strategy which you can utilize. And for self-managed super fund, there should, a lot of people, they don't sign a binding death benefit nomination form. That is a very easy thing to do. You need to only nominate your next of kin in the super, so that if some member dies, then benefit would go directly as per the directions. So that can be done. So these are the 4 categories, and definitely you people are in one of those categories, falling, and you can connect with these categories. Next slide, please. I'm talking about a 80-year darling who is making $180,000 income and got a wife and 2 kids, and he or she will be paying $51,000 to ATO every year. So, which means roughly you are working 1.5 to 2 days in a week for ATO. So for these people, okay, next slide please. They need to take a proactive action. What action they are requiring? Next. So as I discussed, salary packaging, talk to your employer and pay expenses from pre-tax wages. Next please. Super contributions and first home saver, just put some money for super. So if you are taking applying these strategies, effectively you would be roughly 17 grand of tax savings if you apply all those strategies together. If you are applying them individually, strategy 1 could save you about $9,000 and similarly $3,000 each in a second and third strategy. Okay, next one. So being an investor or a business owner, so this would be your plan. Negatively geared property, and okay, if you are having a negatively geared property, numbers would look like, can you move that to next slide please? Sure, just 1 second. I want to show you these numbers. It's a bit blurry. If you have a property which is, there is a loan of $800,000 property, mortgage of 640, so that type of property, if it is a negatively geared, there could be a loss of about $27,000. So that loss can be adjusted against your salary income. So That way, your taxable income will go down and you will have more money in your hands. These property management expenses can also be salary sacrificed. If your employer allow, you can pay agent fee or council rates or other expenses from your pre-tax wages. A lot of people, they don't know that, they don't ask these questions to their employer. So I will encourage you to ask this question. I mean, if they allow it, do that. So your route will be this one, negative gearing property and salary sacrifice expenses. There is another option which is called PAYG holding variation. Look, your employer, they deduct tax from your salary and then pay to ATO. If you are planning to buy a negatively geared property where you're gonna incur a loss, you can ask ATO that I'm expecting a loss in the property. Therefore, my withholding tax need to be varied. It should be reduced. If they would be satisfied, they will issue a approval for that, and your employer would deduct a lesser amount of tax from your wages, and they will give you more money. So that way, you will have more cash in your pocket. That could be invested or that could be used for some other purposes. So this you can explore this with the negatively geared property. Next, please. So the net impact, you were paying about $51,000 tax. Now with the negatively geared property, that would be reduced from $51,000 to $43,000. So roughly $8,000 you can save by implementing this strategy. Next, please. Yeah, your questions. So I've still got 2 minutes. So you can ask questions. I'll give you mic.
I can ask you that one.
Yeah.
You mentioned if you buy a property through a family trust, you are even though if it's from owner-occupier purpose, you are able to ask for tax deductions.
Yes.
How does the capital gain work with that if you were to sell the property?
Look, first of all, to get that benefit, you need to sign trust. Trustees need to sign a formal arm's length agreement with the members of family where they are paying arm's length rent to trust. Okay, so that their arrangement would be arm's length. Then when they are selling the property, that capital gain would be distributed between all the beneficiaries. And then they have to pay tax.
So that would, so it's typically like you have an entity which is buying a property, treating it as a rental investment, and get the benefit at the end of it when you sell it.
Correct.
First of all, thank you so much for such an informative presentation. We're all looking forward to saving $10,000 coming financial year. Just one thing, when you mentioned about buying home in a trust, can we use the First Home Super Saver funds to buy that property through the trust?
Look, First Home Savings Scheme is related to individuals. It's not related to trust.
Right.
When we are buying under a trust, that means your trust should be a trading trust, doing some business under the trust, and then you can have some loan or borrowing capability in the trust, so that you can do that. But First Home Saving Scheme, that is related to individual, and you have to buy under your individual name. But you can combine with your spouse. Both can save money as per First Home Saving Scheme regulations, and then they can pool the funds to buy a property.
But just one, just to add one more thing, can we, would we be able to save on the stamp duty as well, given the current offers from the government when we buy a house a first home, we're able to save on the stamp duty. Would we
Stamp
be able
duty,
to
I think there are some limits on that. I mean, if you are buying a property and there is a certain value, then you have to pay it, or otherwise you are exempt. So that is as per the
But
rules.
like, again, if we're buying through a trust, would we be able to save on the stamp duty?
Stamp duty, I think you have, regardless, you have to pay.
Okay.
This is
Under
only
the trust, we
depending.
do have to pay, right? Okay. Thank you.
Yeah.
Thank you. So I just have one question. If I incur in capital loss, can I adjust that against my taxes that I pay from my salary?
You got a capital loss.
Loss, and I want to trade off against the taxes that I have paid for my
No,
salary.
generally, capital losses are only be adjustable in the capital gains. So you can't adjust your capital losses against your salary income.
Is there a strategy like making a business, doing anything that can redirect those taxes back to my losses?
Capital loss, for capital losses, it's not possible. But if you, like if you are doing a trading business, or you are an investor, that is convertible into becoming a trader. If you are a trader and having a losses in your trading activity, that is adjustable against your salary income. So that is doable, not the capital losses.
Yeah.
First of all, Choi Sahab, thank you very much for giving us your time. I think that's more than worth of 10K for every one of us. Really appreciate your input. I was not very lucky to get that advice like 5 years ago, and I bought my house on me and my wife's name, and same is with the investment property. I always try to get into touch that how we can set up a trust or how can we do it now. So is it possible, or does it cost an arm's length or a lot?
Look, if you're setting up a trust now to protect your assets, it is doable, but it would be a bit costly because you need to, if you are just want to transfer your home to trust, you need to pay stamp duty, title transfer, and then the capital gains tax. But okay, for first home, maybe capital gain tax is not applicable. Still you have to pay a stamp duty, which is a significant cost. For you specifically, for all the people who are just in the same space, you can use a gift and a loan back strategy. Write it down. Gift and a loan back strategy, where you can protect your primary home against any other or third party's claims. So that is doable. And in that gift and loan back strategy, you need not to pay any capital gain, stamp duty or capital gains tax as well. Hope I answered your question.
Excellent.
Thank you very much.
Thank you, Saqib. Well done. That was a great knowledge. I wish I can work in non-profit as well. So many things. There's so many things.